If the YouTube algorithm has sent you here, then you're incredibly lucky. Because I feel confident to claim that this is the most boring video that has been uploaded today, possibly all week. Yes, we're talking about Silicon Valley and a $35 billion takeover. And yes, there is a big fight with government regulators around the world. But we're going to do some intricate arithmetic just to keep the blood pressure under control. Today, we're going to do things back to front. We'll start by looking at the numbers an investor could expect to earn, and then explain why the deal may turn into a slow-motion car crash that destroys committed capital. So, we're in Silicon Valley, and the deal itself isn't anything to tax the grey matter. Synopsis has made an offer to acquire Ansys. For each Ansys share an investor owns, they will receive $197 in cash and 0.345 of a share of Synopsis. So far, so simple. At today's prices, an investor can buy a share in Ansys for $319.13. Shares in Synopsis are trading at $488.95, or $168.69 for 0.345 a share, plus the $197 in cash results in a takeover price of $365.69. An investor looking to arbitrate the deal therefore needs to take a long position in Ansys, short 0.345 Synopsis shares for every Ansys share, then sit back and wait for the deal to close to lock in the rate of return. In this scenario, an investor can expect a return of 15.74%, which translates to 21.6% on an annual basis, or a risk-adjusted return of 0.12%. Should the deal fail to close, an investor can expect a loss of 15.57%. The curious part of this deal, given it is friendly and has been approved by the shareholders, is why there is such a huge spread between the expected return and the risk-adjusted return. We saw that there is an expected return for an arbitrager of 15.74%. We arrive at this number by taking the offer price, $197 in cash, and $168.68 in shares for a total of $365.69, subtracting the cost of an Ansys share, $319.13, adding a short interest credit of $3.69, to figure a net spread of $50.25. We then divide this by the cost of each share, $319.13, to calculate an expected return, should the deal close, of 15.74%. However, when we get to the risk-adjusted return, our calculations also need to incorporate the probability of the deal closing and, conversely, the probability of the deal failing, and the expected loss should the deal fail to close. The probability of the deal closing is an art rather than a science, and our estimate in this instance is 50%, which obviously means there is a 50% chance the deal will fail to close. In a situation like this, where you have a long and a short position, there are two facets to calculate the expected loss. The first is the loss you may expect on the long position. Here we are long Ansys, which we purchased for $319.13. However, should the deal fail to close, it is highly probable that the share price will fall. When we look at the price of Ansys shares in December, before the takeover was announced, we can see a spot price of around $295. This means if the deal fails to close, the share price is likely to fall back to this level, and we would have to unwind our position at that price, taking a loss of $24.13 on the long position. The second part of the expected loss calculation is the loss you may expect on the short position. Here we are short 0.345 a share in Synopsis, which we sold for $168.69. As a mirror image to the long position, should the deal fail to close, it is likely that the share price of Synopsis will rise in value. This is because the company will no longer have the cost of purchasing the target company, nor the inconvenience and possible missteps of trying to integrate the two companies into a single entity. We can see the price of Synopsis before the takeover was announced was $563, or $194.24 for the 0.345 a share we sold. This results in an expected loss of $25.55. When we add together the expected loss of the long position, $24.13, and the expected loss on the short position, $25.55, we have a total expected loss of $49.68. At this point, I really want to check you're all still awake. If you are, and you agree that this is the day's most boring video uploaded to YouTube, please demonstrate that agreement by clicking the like button and subscribing to the channel for more riveting content like this. I would really appreciate it. Anyway, now we know the probability of closing and the expected loss, we can calculate the risk-adjusted return. We have a 50% probability of the deal closing and generating a profit of $50.25, and we have a 50% chance of the deal failing and generating a loss of $49.68. The simple arithmetic here is 0.50 times 50.25 plus 0.50 times negative 49.68 divided by our total investment of $319.13 gives a risk-adjusted return of 0.09%, or on an annual basis, where we calculate the position will be open for 266 days, 0.12%. We can therefore see, despite the respectable-looking return of 15.74% on the face of this deal, the risk-adjusted return is very much lower because of the high probability of the deal failing to close and the losses that would be expected on both the long and short positions. If we were to rerun this scenario, but assume there were no regulatory issues, just a friendly merger between two companies, and so we could increase the probability of the deal closing to 90%, the risk-adjusted return would increase to 17.31%, which is actually higher than the expected return of 15.74%. This is why arbitrageurs are so interested in risk. It really is the difference between very handsome profits and a lifetime of poverty. The next part of our riveting discussion today will focus on the government regulators and why they are so interested in scrutinizing this deal. Honestly, if you don't think this is the most boring video on the platform, you should possibly go outdoors more often. But before you do that, hit the like button. Thank you. So Synopsis is a California-based tech company that specializes in the semiconductor design and manufacturing industry. It is one of the giants of the sector, generating revenue in excess of $6 billion and profit in excess of $1.5 billion a year. The company has a market capitalization of $85 billion and is no stranger to takeovers. Over the past 3 decades, Synopsis has purchased about a dozen companies and has sold several units no longer considered core to its business. Ansys, a company well known to Synopsis via a research and development partnership established in 2017, is based in Pennsylvania and specializes in mathematical software simulation for technology companies, notably for advanced semiconductors, satellites, and medical devices. Like Synopsis, the company is a member of the NASDAQ 100 and S&P 500 indexes. Ansys generates revenue of $2.3 billion and profit of $500 million each year, and prior to this takeover approach, had a market value of approximately $26 billion. Also, like Synopsis, Ansys has been very active in taking over other companies, with more than 30 acquisitions over the last 30 years. However, due to the similarity of the companies, it is perceived by competitors, customers, and regulators that the combination may act as a restraint of trade. Arjun Chauhan, senior analyst at Everest Group, notes, a Synopsis-Ansys merger could certainly impact smaller competitors in the chip design and simulation software market by consolidating critical technology assets under one dominant player. Smaller firms may find it increasingly difficult to compete, as the combined entity could leverage its extensive portfolio to offer bundled solutions at competitive prices, thereby squeezing out rivals. To ensure a level playing field, regulators could potentially impose conditions on the merger that would help maintain competitive dynamics and prevent market monopolization. This was a rather prescient analysis. In March, the U.S. Federal Trade Commission completed an initial review of the proposed deal and announced it was opening an in-depth review. This was followed in August with the UK Competition and Markets Authority opening its own review of the deal, and the Chinese antitrust regulator is also said to be considering a review. This may be part of an emerging pattern of global regulators taking an increasingly tough stance on business combinations. For the fiscal year ending September 2022, the Federal Trade Commission brought 24 enforcement actions, while the Department of Justice brought 26, the highest in over 20 years. In the UK, the Competition and Markets Authority prohibited or advised remedies for nearly 60% of the cases reviewed in 2022, compared to 43% in 2020 and 25% in 2021. Similarly, the EU issued 2 prohibition decisions in 2022 and 1 in 2023 compared to none in 2021 and 2020. This increasingly hostile environment for mergers, especially of large businesses, will be an interesting test for arbitrageurs over the coming years, but certainly not fatal. We recently discussed the proposed merger of Capri Holdings and Tapestry on the channel, and the significant returns an arbitrageur could have made from the transaction. I'll include a link to that in the description below. And with that, I think we can safely conclude the most boring video uploaded to YouTube today. I hope you enjoyed it and are not too drowsy to continue with the rest of your day. What do you guys think of this takeover? Let me know in the comments, and don't forget to like and follow if you found this video useful. Be aware that all the figures mentioned are at the date of my calculations and will change in line with the share price of the company, any change to the takeover price, and the duration to close. As always, this information is provided for educational purposes only. You should not consider anything in this video to be investment or financial advice, nor a recommendation or endorsement to buy or sell any financial instrument. You should always conduct your own research before considering any investment and seek independent financial advice. Thank you, and until next time, enjoy life.